The global financial stage was shaken today as former President Donald Trump issued a blunt warning to China: obey U.S. currency rules or face serious consequences. But just hours later, Beijing sent shockwaves through global markets by dumping billions in U.S. dollars and making a massive $200 billion gold purchase. This bold move marks a major escalation in the ongoing economic tug-of-war between the world's two largest economies. For decades, the U.S. dollar has reigned supreme as the backbone of global trade and finance. Now, China is signaling it may be ready to challenge that dominance head-on, using gold reserves as its weapon of choice, and investors are bracing for a storm. In a fiery statement delivered to reporters, former President Donald Trump demanded that China play fair on currency policy, accusing Beijing of manipulating exchange rates to gain an unfair trade advantage. His warning came as the U.S. struggles with inflation, mounting debt, and growing concerns over the dollar's long-term stability. But within hours of Trump's remarks, China responded with a financial move so bold it sent shockwaves through Wall Street and beyond. Beijing announced it had dumped a significant portion of its U.S. dollar reserves and diverted nearly $200 billion into gold holdings. The purchase marks one of the largest single gold acquisitions in modern history, signaling a dramatic pivot away from reliance on the American currency. Analysts say this could be the beginning of a de-dollarization strategy aimed at reducing China's vulnerability to U.S. financial sanctions and currency fluctuations. For decades, the dollar has been the backbone of global trade, energy markets, and central bank reserves. By shifting to gold, China is essentially betting on a future where the greenback no longer holds uncontested supremacy. This move not only weakens confidence in the U.S. dollar, but also strengthens gold's role as a hedge against geopolitical risk. Financial markets reacted immediately. Gold prices surged to multi-year highs, the dollar index slipped, and investors began flocking to safe haven assets. Economists warn that if other nations follow China's lead, the U.S. could face higher borrowing costs, reduced global influence, and a possible long-term decline in dollar dominance. The currency tensions between the United States and China have been simmering for decades. Since the early 2000s, Washington has repeatedly accused Beijing of keeping the yuan artificially weak to make Chinese exports cheaper on global markets while making U.S. goods less competitive. American officials argue this strategy fueled China's rapid economic growth at the expense of U.S. manufacturing jobs and trade balance. Under Trump's administration, the conflict reached new heights. He launched a full-scale trade war in 2018, slapping tariffs on hundreds of billions of dollars worth of Chinese goods while threatening currency-related sanctions. Beijing responded with its own tariffs and a renewed push to diversify its foreign reserves, which have long been dominated by U.S. Treasury bonds. But the real turning point came when Washington began using financial tools as weapons, imposing sanctions on Chinese companies, cutting access to advanced technology, and even freezing assets in some cases. That made Beijing realize how vulnerable it was to the dollar-dominated global financial system. China's $200 billion gold move isn't just about economics, it's about sovereignty. By building massive gold reserves, Beijing hopes to shield itself from U.S. financial pressure and reduce reliance on a currency Washington can weaponize at any moment. China's $200 billion gold purchase has rattled both economic and political circles worldwide. Financially, the move signals a clear shift away from dollar dependence, shaking confidence in the greenback's long-held status as the world's reserve currency. As China diversifies its reserves, other emerging economies could follow, accelerating a trend economists call de-dollarization. If that happens, U.S. borrowing costs could rise sharply since global demand for Treasury bonds would decline, leaving Washington facing higher interest rates at a time when its national debt already exceeds $37 trillion. Gold markets, on the other hand, surged almost instantly. Prices jumped to multi-year highs as investors rushed towards safe haven assets, fearing long-term instability in currency markets. The dollar index dipped, reflecting concerns that Beijing's strategy could trigger a broader sell-off of U.S. assets if geopolitical tensions worsen. Politically, the gold purchase challenges U.S. financial dominance head-on. For decades, Washington has relied on the dollar's supremacy to enforce sanctions, stabilize markets, and maintain global influence. By moving toward gold, China is signaling it no longer wants to be vulnerable to U.S. economic leverage. This development also boosts China's standing among countries frustrated by Western financial dominance. Nations facing U.S. sanctions, like Russia, Iran, and Venezuela, may now look to Beijing for leadership in creating alternative financial systems. China's $200 billion gold purchase is not a sudden reaction. It's part of a carefully crafted long-term strategy to reshape the global financial order. For decades, Beijing has relied heavily on the U.S. dollar to settle international trade, hold foreign reserves, and stabilize its own currency. But every financial sanction Washington imposes on countries like Russia or Iran serves as a reminder to China. Dependence on the dollar is a strategic vulnerability. By building massive gold reserves, Beijing is creating a safety net beyond U.S. control. Gold cannot be frozen by sanctions, devalued by monetary policy, or manipulated by foreign governments. It holds intrinsic value and has historically been a store of wealth during times of political and economic turmoil. China's ambitions go even further. Through initiatives like the Belt and Road Project and growing trade with Asia, Africa, and Latin America, Beijing is quietly pushing for the use of its own currency, the yuan, in global trade settlements. The gold reserves add credibility to this push, signaling that the yuan could one day be backed by hard assets rather than fiat promises. Ultimately, Beijing wants a multipolar financial world where no single currency, especially the dollar, dominates. This gold strategy brings that vision closer to reality. The global response to China's $200 billion gold purchase has been swift and divided. In Washington, lawmakers called it a direct challenge to U.S. financial leadership, warning that Beijing's actions could destabilize the dollar-based system that has underpinned global trade since World War II. Treasury officials expressed concern that if other nations followed China's lead, it could weaken America's ability to finance its debt and use financial sanctions as a tool of foreign policy. In Europe, reactions were more cautious. Some analysts see China's move as a wake-up call for countries overly dependent on the dollar, while others worry it could spark currency instability and market volatility. Meanwhile, Russia, Iran, and other nations under U.S. sanctions openly praise the shift, viewing it as a step toward a financial system less controlled by Washington. Global markets are now bracing for what some economists call a currency Cold War. If Beijing continues dumping U.S. dollars while expanding gold reserves, confidence in the greenback could erode over time, especially if America's debt keeps climbing. Looking ahead, experts warn this clash might accelerate the rise of alternative payment systems, digital currencies, and regional financial blocs, potentially ending decades of U.S. monetary dominance. The $200 billion gold move marks a turning point in the U.S. China economic rivalry. As Beijing dumps dollars and builds massive gold reserves, the world is watching the foundations of the global financial system begin to shift. For decades, the U.S. dollar has dominated trade, sanctions, and global reserves, but now that supremacy faces its toughest challenge yet. Whether this sparks a new era of currency competition or triggers financial instability will depend on how Washington, Beijing, and the rest of the world respond in the months ahead. One thing is certain: the battle over money, power, and global influence is far from over.